If you would remember, on 6th October 2021, on 6th October 2021, there was a clarification circular issued regarding taxation of services. And in that case, the tax rate on royalty was set to be 18% from 1st of July 2017. They said that the tax rate on royalty is 18% from 1st of July 2017, and this was their interpretation. And on that basis, many notices have been issued in the state of Rajasthan. So what we have done, we have challenged that circular because the circular gives an incorrect interpretation as per our understanding. Circular gives an incorrect interpretation as per our understanding. So this is how we need to see that how the law has evolved. And when I talk about recent amendments, these recent amendments, if I talk, would be having a major impact in future. But in my opinion, the bigger impact would be in the past, because all these amendments have been made through Finance Act, which has been recently notified to be effective from 1st of October to cover up the earlier mistakes. And if we are intelligent enough to identify that what were the mistakes which were there, which have been covered up, believe me, your reply to the notices which are being issued for 3B2A mismatch would be that much more effective. So I would not be discussing the new amendments with respect to the future, what would be happening. I would be linking it with the past, that what was not happening in the past, and even though it was not happening, still we were receiving the notices. So before going on to that part, one more thing which I would like to discuss is how the law is evolved. There are three pillars to the Constitution of India. One is the legislature, second is the judiciary, and third is the executive. The legislature legislates the law. The judiciary judges the law. And the executives administer the law. And these three are having a separate function. One cannot encroach upon the function of other. So you might have gone through many judgments of Honorable Apex Court, wherein they said that as a judiciary, we cannot make law. We can only interpret the law. And we would be interpreting the law as it has been written. If it has been incorrectly written, we will strike down the law. If it is correctly written, we will interpret the law. But we will not legislate the law, because what is the who has been given the power to legislate the law? It is the legislature. So when the legislature has been given the power to legislate the law, who has the power to administer the law? It is the executives, the board, the officers. So whenever you go through a statute, you may find that the act provide that the form would be as may be prescribed, the manner would be as may be prescribed, within such time as may be prescribed. So whenever the term prescribed is written, that means the power to legislate has been delegated by the legislature to executive. But that specific delegation has to be there in the statute. If the power has not been delegated, and without delegation, the power has been exercised by the executives or the board, it is a case of excessive delegation, excessive legislation. So whenever you go through a statute and that it has been written that in the form, in the manner, in the time as we prescribed, that means you would be finding a corresponding rule in the rules. But if you are not finding that rule, that means that although the power has been delegated, but the rule has not been formulated. But at the same time, what happens when there is a reverse case? That the rule has been formed, but the power is not there. it is an invalid law. It is ultra vires. Because when the legislature has not delegated the power to executives, executives cannot frame the rule. And that is what the problem was lying with Rule 36(4). That there was no enabling legislation. There was no delegation of power to bring in Rule 36(4). So what did they did? They brought Rule 36(4) on 9th October 2019, but the enabling legislation 16(2) was made effective from 1st of January 2022. So if 16(2) on 1st of January 2022 says that if the supplier does not file his statement of outward supplies, then the credit would be denied. So what was the locus standi of 9th October 2019 Rule 36(4)? So by amendment to the law, by virtue of insertion of 16(2)AA, you get a very important point while drafting your reply that Rule 36(4) only has an enabling legislation from 1st of January 2022. It has no enabling legislation prior to that. And when Rule 36(4) does not have an enabling legislation, what to say about GSTR 2B? Because the restriction to claim credit up to a certain point till when the GSTR 1 has been filed by the due date. From where it is coming? It is coming from a circular. The circular has a far lesser pedigree than the rule. So the circular itself was ultra vires to the rule. Leave aside the statute. So try to interlink the law with the amendments which are being made and the issues which are being addressed through the amendment. And if we are not making it, somewhere down the line, we are losing out on a very valid submission which can be made part of our hearing. So with this background, let's start today's session on the recent amendments. Is the slide moving, Harsh? Harsh?
Yes, sir. Your screen is sharing.
Slide is moving now?
It's static currently.
No.
Yes, it's moving.
It's moving now? Okay.
Yeah.
Okay. So let's start with the first amendment, that is section 37. When I go through this amendment, on the face of the amendment, I think that what is the major amendment which has been made? There is no major amendment which has been made in the law. And it's the simplest of the things to be GSTR 1 would be filed subject to such conditions and restrictions. But let's try to analyze it in deep. Because very soon you would be receiving a notices for ITC mismatch in the ITC claimed in 3B vis-a-vis GSTR 2B. So the words marked in red is an amendment. So one amendment is every registered person shall furnish his GSTR 1 subject to such conditions and restrictions. But the second and the most important amendment in section 37. Previously, what was written? The details being filed by the supplier shall be communicated to the recipient of such said supplies within such time and in such manner as may be prescribed. So what was section 37 saying? That the details which have been filed would be communicated to the recipient within such time and in such manner as may be prescribed. So from where the manner and the time was prescribed, it was prescribed in Rule 59 sub Rule 6. Because the term prescribed has been written, that means a rule has been framed for it or has to be framed for it. But now this term has been deleted and new words have been inserted, substituted, which says shall subject to such conditions and restrictions within such time and in such manner as may prescribed be communicated to the recipient of said supplies. So they have inserted subject to such conditions and restrictions as may be prescribed will be communicated to the said supplier. As will be communicated within subject to such condition and restriction as may be prescribed. So why they have inserted subject to such condition and restriction? Because now 2B is being generated up to a particular date, and the outward supplies details filed after that date are being communicated in next GSTR 2B. So this is the restriction for communication of the supplies to the recipient, which they want to insert through section 37, which was not there prior to this amendment. So now the question comes that GSTR 2B is being generated not from 1st of October 2022. It is being generated from 1st of July 2021. And the government is asking from that point onwards that you have to claim ITC only as per GSTR 2B. So now the thing comes that when the law did not provide for the conditions and restrictions for communication of details to the recipient, how the GSTR 2B was brought in, how that restriction on communication of inward supplies to recipient beyond a particular date was brought in. And mind you, this is not a retrospective amendment. It is a prospective amendment. So whenever you are receiving a notice on 2B for period prior to 1st October 2022, you have to incorporate that the restriction being placed on communication of details of inward supplies to a recipient beyond a certain date is ultra vires, because the enabling legislation has only been brought from 1st of October 2022. Leave apart the right to claim. What I am talking is the right to being communicated of the outward supplies being filed by my supplier. Because the relevant rule has also already been inserted, but the enabling legislation has been brought in late. This is the subtle changes, the small changes which whenever they are brought in the law. If we are able to interpret, if we are able to identify what are the lacunas which they were trying to remove, we would be able to prepare a reply that much more better. The second amendment in section 37. The registered person shall not be allowed to furnish the details of outward supply during the period from 11 day to 15 day. This proviso has been deleted because now no longer 1, 2, and 3 are there. So all the consequential amendments for which provided 1, 2, and 3, all the consequential statute provision which provided for filing of 1, 2, and 3 have been either deleted or been suitably amended. The next is section 37 subsection 2. Now, since the entire section 38 has been remodeled, so the previous section 37(2), which provided the recipient would accept and would reject, and that it would be again communicated to the supplier, all these have been done away. So section 37(2) has been omitted. Now coming to section 37(3). Section 37(3), which allowed amendment to GSTR 1 up to the furnishing of return under section 39 for the month of September, has now been amended to link it to 30th day of November. And a press release has also been issued by the government that this limit of 30th day of November would also be applicable to 2021-22. The next amendment, section 37(4). Previously, what was happening, if I want to file a GSTR 1 on the current date for the current month, I was able to file even though I have not filed GST1 for the previous months. Now they have provided that if the previous month's GST1 has not been filed, then the next month GST1 would not be allowed to be filed. So this is the amendment to section 37, and which has a far greater impact on GST 2B, which was prevalent prior to insertion of this amendment. Section 38. Now, whenever I read the newly substituted section, I always feel that I was reading this even before this amendment. From where I was reading? I was reading through Rule 60, Sub-Rule 7. Now section 38 has been inserted. And prior to this, I was reading the same provision in Rule 60, Sub-Rule 7. The question comes, if 60 Sub-Rule 7 was already in place and section 38 has been made effective from 1st October 2022, where was the enabling legislation prior to this? See, these amendments are very important in understanding and preparing your reply for ITC. Whenever I discuss these amendments, somewhere down the line, I think that I am taking a session on input tax credit and how to prepare replies on input tax credit. Because ITC is something which the taxpayer does not want to leave, and ITC is something which the government does not want to give. And all the majority of the amendments are focusing on this ITC aspect. And interestingly, all these amendments are trying to cover what was already prevalent. So when section 38 subsection 1, the newly substituted section 38 says that the details of input tax credit shall be made available electronically to the recipient of such supplies in such form and manner within such time and subject to such condition and restriction as may be prescribed. So when the rule making power has only been given on 1st of October 2022, how come Rule 60 Sub-Rule 7, which provided an auto-drafted statement containing the details of ITC shall be made available to the registered person for every month electronically through the common portal? And interestingly, if we go read through the minutes of the 43rd GST Council meeting, in my presentation, I have also referred to the minutes of the GST Council meeting. What para 2 says? The new section to provide that details of inward supply shall be made available to the recipients in prescribed manner. This is essentially an enabling provision to provide for GST 2B. The requirement of reversal of ITC arises from Chapter 5 and is therefore not required to be mentioned under this section. So they themselves are saying that the enabling provision is being inserted to section 68. So how does the GST 2B comes into picture prior to 1st October 2022? And believe me, from 1st of July 2017 to 1st of October 2022, this litigation of ITC is going to continue up to 2028. Because the annual return for 2023 would be filed on 31st of December 23, and there are 5 years. So this is not as if we are talking about something which is a thing of the past. It is a thing of the future, because all the litigation lies ahead. It is not in the past. We all enjoyed a honeymoon period in GST in the first 3 years. The taxpayers enjoyed a honeymoon period in GST in the first three years. Now they would be facing the music. So section 38 subsection 1 says that the details would be made available electronically to the recipient in such form, in such manner, within such time, and subject to such condition and restriction as may prescribe. And as we have discussed right at the start, that when the statute uses the word as may prescribe, a corresponding rule has to be there. And while you are reading through a law, make it a habit. Try to identify, if you are reading a section and you find a term as we prescribe, try to identify what is the corresponding rule to that section. It would enhance your learning. It would enhance your understanding. Now 38 subsection 2. It says the auto-generated statement under subsection 1 shall consist of details of inward supplies in respect of which credit of ITC may be available to the recipient, and details of supply in respect of which credit cannot be availed, whether wholly or partly by the recipient on account of the details of said supplies being furnished under subsection 1 of section 37. So GSTR 2B, it says that in future it would be reflecting details of inward supplies for which ITC is available and details of inward supplies for which ITC is not available on account of following reasons. As I have said, this mechanism is already in place. If we go through 2B, it has two tabs: one, available, not available. So what are the conditions for which 2B would be showing that the ITC is not available either wholly or partly? If GSTR 1 has been filed by the supplier who has taken a new registration, so they would be providing through a rule, because it uses as we prescribed, that if they would be providing through a rule by way of insertion of a rule, that if a new registration supplier has filed his GSTR 1, so therefore within such period of taking registration, ITC would not be available either wholly or partly to the recipient. Second, ITC would not be available to any registered person who has defaulted in payment of tax and where such default has continued for such period as may prescribe. So if my supplier has defaulted in payment and even though he has filed his GSTR 1, I would not be eligible to claim credit because it would be shown in ITC not available. Third and most interestingly, ITC would not be available for any registered person the output tax payable by whom in accordance with the statement of output supplies furnished by him under the said subsection during such period as may be prescribed exceeds the output tax paid by him during the said period by such limit as may be prescribed. So if there is a difference between a GSTR 1 and a 3B of my supplier, I would be denied the credit. So supposedly my supplier has declared tax of say 5 lakh rupees in GSTR 1, but he only pays tax of rupees 3 lakh in GSTR 3B. My ITC would be denied. Now the question comes that whether at all this amendment in clause 3 takes into effect the circular issued on 29th of December 2017, 26/2017. Which says that if any excess supplies, outward supplies have been declared in GSTR 1, it may be adjusted in subsequent months. Or if any tax has been paid in excess in the previous month, it can be reduced from the next month. So if my supplier in previous month has declared outward supplies of say 5 lakh in GSTR 1, but paid 7 lakh in 3B, and in the next month he reduces that 2 lakh. How come the system would identify whether it would carry out a reconciliation for the entire period from 1st of July 2017? Or if my supplier has declared in 1 and has paid the tax to DRC 03, how would the system would know that how much tax has been paid? And whether at all I can go and talk to my supplier that you have deposited less tax, I want to inspect your accounts. Why you have deposited less tax? And what I can say, the joke does not stop here. The clause 4 goes one step ahead, and it says that if your supplier from whom you have purchased has claimed more credit in this GSTR 3B than what was available in 2B, your ITC would be denied. So if my supplier has a credit of say 1 lakh rupees in his 2B and he claims 5 lakh in his 3B, this clause says that you would not be allowed the credit because your supplier has claimed excess credit from what was being reflected in 2B. And supposedly, if I go to my supplier and say that why you have claimed your more credit in 3B than what was available in your 2B, what would my supplier say? That who has given you the right to interfere in my business? Who are you to ask me? Do you have a legal power to ask me? I would claim credit as per my books and I would litigate it up till the Honorable Apex Court, and I will ensure that I will put my best foot forward before the Honorable Apex Court, and I know that I will win. Can I ask my supplier that no, my 38 subsection 2 clause 38 2B subclause 4 says that you cannot claim more than 2B, so you have done a wrong. He would ask me that you can go and manage your own business, don't try to interfere in my business. This is the best which a recipient can do. If his supplier takes more credit in his 3B than the 2B. The next clause 5, that if my supplier has defaulted in discharging his liability in accordance with the provisions of subsection 12 of section 49. What section 12 of section 49 says? That you have to pay certain percentage of tax in cash if you satisfy certain conditions as we prescribed. Now you would say, sir, this is something I have already heard. Yes, we have already heard. 1% output tax to be paid in cash. There's already a rule in place. And when there's already a rule in place, then what this 49 subsection 12 says? Because this 49 subsection 12 has also been inserted through this Finance Act only. So when 49 subsection 12 has been inserted through this Finance Act, and there's already a rule prior to this insertion of new section 49 subsection 12, what is the locus standi of that rule? Again, the rule coming before this provision 49 subsection 12. And the last but not the least, by such other class of persons as may be prescribed. So if they had to provide in the subclause 6 that credit would not be allowed for inward supplies from such other class of person as may be prescribed. So what was the reason of writing from subclause 1 to subclause 5? It would have been directly made as part of subclause 1. And the entire power could have been delegated to the executives. See, in all the clauses of subclause 1 to subclause 5, as may be prescribed has been given. So the executives have been given ample power to frame the rules, to bring in the rules, to bring in the restriction. As if the recipient has all the powers in the statute to freeze the bank account, to provisionally attach the bank account, to provisionally attach the asset, to go and search and investigate the premises of their supplier, to go and investigate the books of accounts of the supplier. So the persons who have been entrusted with all the power, they have only assumed that they are here only to make the rules, and the persons who are there to carry on the business have been asked to perform their function without any power being delegated to them. And in my opinion, I'm not able to find an appropriate word which defines this provision in a less abrupt manner. But this section 38 in my 20-year practice career is one of the most absurd provisions which have been inserted, wherein a recipient has been casted with all the responsibilities without any power available to him, and this provision of section 38 is clearly against the statement of object and reasons which were provided while GST law was brought, because the recipient is being asked to pay tax twice, once to the supplier and second to the department. So it's better that a tax rate is brought which is without ITC rather than complying with all these restrictions. So this is section 38. Now, these are the judgments which we commonly refer, and I am making it as part of my presentation also, that whenever you receive a notice for a difference between a 3B or a 2A or non-payment of tax by the supplier, whether the recipient is eligible to claim the credit. These are the judgments which are in favor of the pre-GST regime. These are the judgments which are against, somewhere against. And interestingly, I have written D.Y. Beethel Enterprise versus State Tax Officer as the judgment against the taxpayer. And there is a specific reason attached to it. Because we very commonly say that there is judgment of D.Y. Beethel Enterprise which says that the first action has to be taken against the supplier for non-payment of tax. But this judgment stops here. It nowhere states that even if the action is taken against the supplier and they have not deposited the tax, still a genuine purchaser would be entitled to ITC. So whenever I quote this section, I quote this judgment, it is always in the alternative and without prejudice to challenge the right of a genuine purchaser. It is not something which I can quote straight away, because if I quote only this decision, the department would say that we have taken an action against that supplier and he is non-existent, so now you are required to pay the tax. There is a judgment of Honorable Calcutta High Court in GST regime or LGW Industries Limited, which we should always quote. So this is all about section 38. Now coming to amendment to section 16. 16(2)(ba) has been inserted, and which provides the details of input tax credit in respect of said supply communicated to such registered person under section 38 has not been restricted. So now 2BA says that a recipient would only be eligible to claim the credit provided it has not been restricted under section 38. So the conditions which were only 4 prior to 1st of January 2022, now there are 6 conditions. Out of those 6 conditions, the first is I should have the invoice, which I don't have any problem with it. I should have received the goods or services. I don't have any problem with this. I should have filed the return, because all these 3 conditions, receiving the invoice, receiving the goods or services, or filing the return, these all are in my domain. These all conditions are within my control. But rest of the 3 conditions, section 16(2)(c), my supplier should have paid the tax, not within my control. My supplier should have filed the GSTR1 from 1st of January 2022, not in my control. And if the provision has been inserted from 1st of January 2022, God knows how it was applicable prior to 1st of January 2020. And 16(2)(ba), that it should not be restricted under section 38. What is section 38 restriction? GSTR 2B. And if it is applicable from 1st of October 2022, why the hell it was made applicable prior to this? So section 16 2BA is a somewhere what I can say the enabling section for section 38 and an enabling section for rule 60 sub rule 7 and an enabling section for GST 2B. Now coming to section 16 2C. 16 2C presently have reference to section 41 and section 43A. Now interestingly this section 43A was nothing but rule 36(4). And this section 43A was inserted through CGST Amendment Act 2018. But this provision was never notified. The effective date of this section was never notified. And since the effective date for this section was never notified, so they brought in a stopgap arrangement of Rule 36(4), for which the enabling section was brought on 1st of January 2022. Now, since section 43 has not been notified till date, so the reference to that section in the statute has been deleted. Section 16 subsection 4. As we all know that the due date for claiming of the ITC for previous financial year has now been extended to 30th of November. Now there's a discussion on this aspect in the 43rd GST Council meeting. See, all these amendments were discussed in 43rd GST Council meeting. So if we are able to go through those minutes of the meeting, you would be able to understand the rationale behind these amendments being carried out. So in that particular minutes, it has been clearly provided that law committee has recommended a fixed date of 30th November next financial year be fixed for all these compliances, and it serves two purposes. It provides one more month to the taxpayer to amend the returns, and the portal will not allow any amendment after this date. Again, I don't know what stopped them to link it with 31st of December due date of filing of annual return. Why it has been stopped short on 30th of November. And what this 30th of November does, that it gives an additional month, 1 month. But if it would have been linked with 31st of December, that is due date of filing of annual return, the things would have been resolved, because any lapsed ITC, if found, or any particular ITC, ITC which has not been claimed, not lapsed ITC, any ITC which has not been claimed, if it is found during the course of filing of annual return, it would have been claimed. But whatever we get, take it with open arms. So the date has been extended to 30th of November. Amendment to section 29. Previously, section 29B, clause B provided that a person paying tax under section 10 has not furnished returns for 3 consecutive tax periods. Now this 3 consecutive tax period, because the filing of return was made annual in case of composition scheme. So it meant that if a composition person did not file his return for 3 years, his registration cannot be cancelled. Now this provision has been amended to say that the return for a financial year beyond 3 months from the due date of furnishing said return. So the due date is say 30th of April. Yeah, if the return is filed by 31st of July, the registration can be cancelled. Section 29 clause C, which says that for person other than falling within the ambit of composition scheme has not furnished the returns for a continuous period of 6 months. This was the previous provision. Now, since the return filing was divided in 2 parts, the monthly return and quarterly return, so it has been suitably amended to provide such continuous tax period as we prescribed, and the enabling rule has been brought in from 1st of October 2022, which says 6 monthly returns or 2 quarterly returns in case of a QRMP taxpayer. Section 34, the due date of issuing the credit note or reporting in the return, it has also been extended to 30th day of November. Section 39(5), for return to be filed by a non-resident taxable person, which was previously 20th day, now it has been the due date was 20th day from the end of the month. Now it has been reduced and brought to 13th day of the 13th day after the end of the month. Section 39(7), Now, interestingly, this 39(7) is there to provide for notification of the QRMP scheme. Now, this QRMP scheme was already notified in the month of November 2020. But this provision has now been inserted to provide or enable to bring in a scheme for QRMP taxpayer. And if you go through the minutes of the 43rd GST Council meeting, it says to provide that for monthly payments by quarterly taxpayer, government may prescribe that instead of self-assessed tax, a prescribed amount may be paid. This is being covered by a special procedure. So the special procedure was brought in the month of November 20, but its enabling legislation has been brought from 1st of October 2022. Amendment to Section 39(9), wherein the due date to make the required amendments for filing of return for the month of September, due date of filing of return for September, now it has been extended to 30th day of November. Section 39(10). Now, 39(10) previously only provided that if previous month's 3B has not been filed, then current month's 3B cannot be filed. Now they have amended to provide that if previous month's 3B has not been filed or if previous month's GSTR 1 has not been filed, then the current month 3B would not be filed. So now it is very clear that if you have not filed your GSTR 3B for the previous month, you would not be allowed to file your GSTR 3B for the current month. If you have not filed GSTR 1 for the previous month, you would not be allowed to file GSTR 3B for the current month. But again, somewhere down the line, these restrictions are already there in place. So again, the law has been amended subsequently and the rules have been brought in prior to this amendment. Now, one important amendment under Section 41. Previously, what Section 41 provided? It provided for acceptance of a provisional credit. What was the previous mechanism that was designed for implementation on 1st of July 2017? It provided that my supplier would file his GSTR 1. I would be receiving details in GSTR 2. I would be accepting those details, and the details which have not been filed, I would be manually inserting those details. And on the basis of manual insertion, I would be able to claim that credit provisionally. And those manually inserted details would be communicated to my supplier. And if he accepts it within 1 month, the provisional credit would be final credit. But if he does not accept, I would be required to reverse that credit and reclaim it only when he has accepted it. So what they said that all the provisional credit which has been claimed until it is finally accepted by the supplier would be a provisional credit, and only self-assessed liability would be allowed to be discharged through it. But 1, 2, and 3 never saw the light of the day. So this entire Section 41 has been substituted with a new provision. And this Section 41 is something which provides a procedure for Section 16(2)(c). And Section 41 subsection 1 says every registered person shall, subject to such condition and restrictions as may be prescribed, be entitled to avail the credit of eligible input tax else as self-assessed in his return, and such amount shall be credited to the electronic credit ledger. So every registered person shall, subject to such conditions and restrictions as may be prescribed, and this is the new mantra of GST law. Every section has been written with the word such condition and restriction, or with such manner, within such time limit, with such form as may be prescribed. So all the power has been delegated to the executives. And these conditions and restrictions are not far away from being incorporated in the rule. These rules are only an initial amendment which has been made effective from 1st of October 2022. Wait for the subsequent rules to come to bring into effect this section 38 and section 41. 41 subsection 2 say the credit of input tax availed by a registered person under subsection 1. Now, my claim under subsection 1 was subject to such condition and restriction as we prescribed. Now they put further condition in the subsection 41(2), which provides that the credit of ITC availed by a registered person under subsection 1 in respect of such supplies of goods or services of both, the tax payable whereon has not been paid by the supplier shall be reversed along with applicable interest by such person in such manner as we prescribe. So again, as we prescribed, but you have to reverse that credit if the supplier has not paid the tax. First of all, if your supplier has not paid the tax, you are not entitled to claim the credit. But supposedly it was he filed his GSTR1 and in by way of section 38 it was shown in the credit available and you claim the credit and subsequently department comes to know that the 3B has not been filed. You are required to reverse the credit along with interest. Now the proviso says that provided that where the said supplier makes the payment of tax payable in respect of aforesaid supplies, the said registered person may reavail the amount of credit reversed by him in such manner as we prescribed. So again the prescription is involved, but if the supplier has paid the tax, then only you are entitled to avail what? Only the credit. But mind you, if my supplier has paid the tax after delay, he is also liable to pay the interest. And once he has paid the interest, my claim of claiming the credit dates back to actual date when I had the invoice. So if 41 subsection 2 provides that I have to reverse the credit along with interest, then why, if my supplier has paid the tax along with interest, I am not recredited with the interest which I have earlier paid. I am only recredited with the credit which I have reversed earlier. This is purely a case of unjust enrichment wherein the government is taking interest from both the recipient and the supplier. And even though my supplier has paid his tax along with interest, still I am not being refunded the interest which I have already paid. Because supposedly if my supplier has issued the invoice in January 2022, I claim the credit in February 2022, I reverse it in July 2022 along with interest. But if my supplier pays it in September 2022 along with interest, then my claim dates back to January 2022. It is no longer dating from September 2022. And I should be refunded the interest which I have already paid. So this section 41 is nothing but an enabling section to recover the interest even though my supplier has paid the interest on delayed payment of tax. Section 42, 43 and 43A. Now, just going back again to GSTR 3B and 2A mismatch and the notices which we are receiving. 99% of the time, you would not be finding any section being referred while issuing the notice. All the listeners who are part of this session, we are all sitting at our office or at our home and being part of this lecture. And all of us have received a notice of a 3B and 2A mismatch. Have you ever seen that what is the section being referred on that notice? It is always section 73 and 74. But section 73 and 74 are only section for demand and recovery. They only provide that ITC which has been wrongly availed or wrongly utilized is liable to be recovered under section 73 and 74. So which section provides for ITC wrongly availed or wrongly utilized? It has to be mentioned on the notice. If I claim a credit beyond a particular due date provided under section 16 subsection 4, so I have wrongly availed or wrongly utilized ITC under section 16 subsection 4, read with section 73-74. So similarly, where there is a difference between a 3B and a 2A. It is not section 73 alone, it has to be some operative section. So 99% of the time I don't find any reference to the operating section, they only refer section 73 and 74. And rest of the 1%, either you will find 16.2C, wherein I say that a mismatch between the 3B and 2A is not 16.2C, because 2A is based upon 1 and a person can still deposit a tax under 3B without filing 1 or not reporting the outward supplies in GSTR1. So 16.2C is, in my opinion, not applicable. In rest of the half percent, I see section 42 being referred. Now this section 42 itself has been deleted. And when this section 42 itself has been deleted, it has been deleted because the provision of GSTR 1, 2 and 3 could not be brought in place. And once it could not be brought in place, therefore section 42 cannot be implemented. And once section 42 cannot be implemented, how come there can be a mismatch or a demand under section 42 against me? So whenever you receive a 3B and 2A referring to section 42, make it a part this amendment. Section 43, sometimes we receive a notice that since you have issued a credit note, but your recipient has not reversed the credit, therefore you are not entitled to reduce the output liability. From where it is coming, section 43. And what proposed, what the 43rd GST Council meeting says about section 43, the existing section 43 may be omitted as a whole, as the concept of two-way communication proposed earlier in GST 123 model is proposed to be done away with, and liability to be determined on self-assessed basis. So when the proposed method, and mind you, the minutes are writing proposed in earlier GSTR 123 model. So when the proposed model itself could not be brought in place, how can there be a demand for violation of section 43? In section 43A, as we have discussed, that it was part of CGST Amendment Act 2018, but it was never notified. So this section was nipped in the bud. It never rose. So therefore, it was deleted from the statute itself. So this deletion of section 42, 43 and 43A gives me a very strong ground that no demand for 3B2A mismatch can be raised under section 42, or no demand for non-reversal of ITC by the recipient can be created on the supplier if he has issued a credit note and reduced his output liability. So as I said at the start, that these amendments are not important only for future, but they are having a much broader impact on the past as well. Section 47, and this is the favorite amount which is collected by the system, that is late fees. And somehow while drafting the law, they forgot to insert the relevant provision of section 52. And now when they have come to know that they have forgot to mention section 52, they have amended the provision and provided that a late fees on filing of TCS return can be levied in the statute. Section 48 is relating to the GST practitioners, and it is only a consequential amendment because it provided for filing of GSTR 2 under section 38. Now, since GSTR 2 is no longer to be filed, therefore the reference has been omitted. Section 49. Section 49(2) provided for crediting of the ITC on the basis of self-assessment in the electronic credit ledger. in accordance with section 41 and section 43A. Now, since section 43A has been abolished or deleted, so the consequential reference to section 43 has also been deleted. Section 49 subsection 4. Now, this is one interesting amendment. Section 49 subsection 4 provides that the amount available in the electronic trade ledger may be used for making any payment amount available in electronic trade ledger may be used for making any payment towards output tax under this act or under the integrated tax act in such manner and subject to such condition and restriction and within such time as may prescribe. So the manner, the restriction to use the credit has now been inserted from section 49 subsection 4. But this was already there in a statute by way of rule 86A, blocking of electronic trade ledger. And once the rule was there, the enabling section has only been provided under section 49 subsection 4 from 1st of October 2022. Again, the law being implemented later on, but the rules being implemented earlier. Section 49 subsection 10, which allowed transfer of cash ledger amount from one registration to another registration of same person. 49 subsection 10 now has been inserted and the enabling rule has also been brought. So now the transfer can be made from one registration to another registration. 49 subsection 12, as we had already discussed under section 38. And it says that notwithstanding anything contained in this act, the government may, on the recommendation of council, subject to such condition and restrictions, specify such maximum proportion of output tax liability under this act or IGST act, which may be discharged to the electronic credit ledger by a registered person. Rule 86B, which was inserted from 1st of January 2021. Now the enabling section has been brought under section 49 subsection 12. Section 50 subsection 3. Now previously section 50 subsection 3 provided for an interest rate of 24%. Now with this Finance Act 2022, it has already been reduced to 18% with retrospective effect. But also 50 subsection 3 has also been amended to provide that interest would only be leviable wherein the ITC has been wrongly availed and utilized. And the enabling rule in rule 88B has also been notified. We would discuss this going forward when we discuss rule 88B. But although I would say that it is a welcome amendment to the statute, but at the same time, I would say that this is not something which has been given from this Finance Act only. If we go through section 50 subsection 1 or 50 subsection 3 as was prior to this amendment, still interest could not have been levied on the ITC which has not been utilized. This discussion is for some other time, but even prior to this amendment, ITC wrongly availed was not subject to interest. It was only ITC availed and utilized. And there is a subtle difference between a section 73 provision and a section 50 subsection 3 provision. And we always confused section 73 with section 50. Because section 73 you use the words utilized or availed. So we always thought that since the section 73 provided for your ITC wrongly availed or utilized, therefore interest is also leviable on ITC wrongly availed or utilized. It was not so. Section 73 always provided ITC wrongly availed or utilized is an offense and interest would be payable as per the provisions of Section 50 subsection 3. Section 50. Not 50 subsection 3. Interest would be payable as per the provisions of Section 50. And there is reason why penalty is leviable on ITC wrongly availed or utilized, and interest is leviable only when ITC has been wrongly availed and utilized. See, interest is always compensatory in nature. So if I've used any amount, then only I would be liable to pay the interest. Take an example that you have sanctioned a loan, but you never disbursed the loan. So merely sanctioning of the loan would not be there for levy of interest. Only on the disbursal, interest would be leviable. So this is the same concept for Section 50 also. Previously, in my opinion, Section 50 subsection 3 was never applicable because the entire mechanism of Section 42 and Section 43 was never in place. And as per 50 subsection 1, it was only interest, not tax not paid or short paid. And when I read through Section 73, this is the provision for demand and recovery. This is the provision which provides for a penalty in case an offense is committed for ITC wrongly availed or utilized. So while drafting an offense, I can always say that wrong availment of ITC is also an offense, because penalty is always derogatory to stop the person from doing wrong thing, even though it might not have caused any wrong to someone, but it might have caused wrong to someone in some other situation, or it could have caused. So therefore, whenever an offense is provided, it is never compensatory. A penalty is always derogatory, and therefore wrong availment or wrong utilization both are offenses. So Section 50 subsection 3 that we will be discussing going afterwards along with Rule 88B. Section 52, the due date for amendment has been again shifted to 30th day of November. Section 54. Now again, the cart before the horse, what I can say, because in the entire amendment, this has become the norm. Now a proviso to Section 54. One has been amended to which provided for refund from cash ledger. Now this has been amended to provide that the form in which the cash ledger refund would be claimed would be as may be prescribed. Now we were already claiming the refund from cash ledger, but the only thing was that the enabling provision in the statute was missing. So now that enabling provision on the statute has already been also been made, even though this process was already implemented from 1st of July 2017. (54) subsection 10. Now section 54 subsection 10 previously provided that where any refund is due under subsection 3 to a registered person, that may be withheld. Now this refund under refund due under subsection 3, the term under subsection 3 has been deleted. So now any refund which has been claimed can be withheld by the officer if return has not been furnished or if any demand is there against the person. That this rate of interest, reduction of interest rate to 18% that we have already discussed. Now coming to Rule 88B, that is calculation of interest. Now This rule 88B is applicable not only for 50 subsection 3 but also for 50 subsection 1. Now what this rule 88B subrule 1 says, it says in case where the supplies made during a tax period are declared by a registered person in the return for the said period and the said return is furnished after the due date in accordance with the provision of section 39. So the important term is supplies made during a tax period are declared by the registered person in the return for the said period. So if the supplies have been made in July 2017 month, they have to be declared in the return for the period of July 2017. And if that return for July 2017 is furnished after the due date, then the interest would only be payable on the cash component. But if the supplies have been made in 1 month and they are declared in the return for another month, then in such case, this proviso of section 50 subsection 1 would not be applicable and interest would be payable on the gross amount. So let's take an example. That tax on total supplies made in the month of July 2020 are say 1 lakh rupees. Tax declared in the GSTR 1 for the month of July 2020 is 1 lakh rupees. And the ITC available in the month of July 2020 is 1,20,000. So ideally, if I declare my outward supplies correctly and claim my ITC correctly, I have an excess balance of 20,000 rupees. Now, supposedly my return for July 2020 is filed say in the month of May 2021. But I declare the correct liability and I claim the correct credit. So even though my return has been filed late, I would not liable to pay any interest. But supposedly, I have filed my July 2020 return by 20th of August 2020 and declared outward supplies of 80,000 only, and were due to clerical error or any error, I short reported by 20,000 in 3 weeks. But I claimed my all ITC. And that 20,000 rupees, that short reporting of 20,000 is declared in the return for the month of May 2021. Now, since the supplies were made in July 2020, they should have been declared in the return for the month of 2020. But since they have not been declared in the return for the month of 2020, but they have been declared in the return for the month of May 21. So even if there is an excess ITC available in the credit ledger, still the interest would be payable on gross amount of 20,000 rupees. So we have to be very careful while we are filing our GSTR 3B. There was one case which came to us wherein a compensation cess of 6 crore rupees was not reported. And ideally, the output liability of compensation cess is equal to the credit being claimed of compensation cess. So there was the output liability of 6 crore rupees and there was a consequential ITC of 6 crore rupees. But both of them were not reported and they were reported after 1 year. So when this was done after 1 year, now making this proviso to section 50 subsection 1 and rule 88B subrule 1 applicable, the interest is payable entirely on that 6 crore rupees because it has not been declared in the month, in the return for the month in which they were made. And this would be a huge bone of contention between the assessee and the tax consultant, that who would be liable to pay that interest. And make it a practice that even if a GSTR 3B and 1 is filed, while the next GSTR 3B is being filed, there is a reconciliation that whether properly output liability was declared in the previous month's 3B vis-a-vis GSTR 1. Because even if there is an error, it is stopped and it is corrected in the next one. So this is about 88B sub-rule 1 and sub-rule 2. And if I go through the minutes of the agenda to GST Council meeting, it also provides the same which has been provided in the rule and what we have discussed, that accordingly the interest would be charged on the delayed payment of the amount payable through electronic cash ledger. However, where the invoices of the debit notes have been uploaded in statements pertaining to the period subsequent to the period in which they should have been uploaded, the interest shall be calculated on the amount of tax calculated on the taxable value from the date on which the tax on such invoices was due. So coming to 88B sub-rule 3. Now this is pertaining to 50 subsection 3, which provides that interest is payable when ITC has been wrongly availed and utilized. So this 88B sub-rule 3 says that in case where interest is payable on the amount of ITC wrongly availed and utilized, in accordance with subsection 3 of section 50, the interest shall be calculated on the amount of ITC wrongly availed and utilized for the period starting from the date of utilization of such wrongly availed ITC till the date of such reversal of such credit or payment of tax. So starting not from the date of availment, but from the date of utilization and ending till the date of reversal of such credit or payment of tax in respect of such amount. So now the question comes that what is the date of utilization of wrongly availed ITC? For this, an explanation has been inserted in Rule 88B. And this explanation says that ITC wrongly availed shall be construed to have been utilized, where the balance in electronic credit ledger falls below the amount of ITC wrongly availed. And the extent of such utilization of ITC shall be the amount by which the balance of electronic credit ledger falls below the amount of ITC wrongly availed. So if I wrongly availed ITC of 1 lakh rupees, whenever the credit ledger balance falls below that 1 lakh rupees, I would be provided that I have wrongly utilized that amount of ITC to the extent it falls below the ITC wrongly availed. So supposedly I have wrongly availed an ITC of 1 lakh rupees. And 2 months afterward, the balance goes down to 80,000 rupees. Now, it would mean that I have wrongly utilized 20,000 rupees, but because my credit ledger balance is lesser by 20,000 rupees as compared to the ITC wrongly availed. Now, this is the amount of ITC wrongly utilized. What is the date of utilization of such ITC? The date of utilization of such ITC is the date on which the return is due to be furnished under section 39 or actual date of filing of the said return, whichever is earlier. So supposedly I have claimed ITC say in the month, availed ITC in the month of July 2020. And I am a new dealer. But I incorrectly avail a ITC of 1 lakh rupees. I file the return and there are no outward supplies. My August outward supplies are nil. My September outward supplies are nil. My October outward supplies are nil. So in all these months, my balance would be same as 1 lakh rupees. So I have not utilized any ITC till now. So there is no question arises for levy of interest. But in the month of say November, there is no ITC, but I have made an outward supplies of 20,000 rupees. Now I utilize this 20,000 rupees while filing the return for the month of November. Now my credit ledger balance goes below 1 lakh rupees and it is now at 80,000 rupees. Now, what would be the date of utilization? Now, there are two scenarios. First is supposedly I file my return on say 15th of December and the due date is 20th of December. I would be liable to pay interest from 15th of December because I have filed my return on 15th of December. In the second case, supposedly the due date is 20th of December, but I filed my return on 25th of December. Now, in this case, although I filed my return after the due date, but the interest would be payable from 20th of December, that is the due date of filing of return. So that's why explanation 2 to rule 88B says that date of utilization of ITC shall be the date on which the return is due to be furnished under section 39 or the actual date of filing of the said return, whichever is earlier. Or if the tax has been paid through DRC 03, then the date when the DRC 03 has been filed. This is the example for calculation of interest that we have already discussed. Now there is one interesting case study which I have put. Supposedly in the same example of I have claimed a wrong ITC in the month of July 2020. I don't have any outward supplies in that month. I don't have any outward supplies in August. I don't have any outward supplies in September. I don't have any outward supplies in October. And I have an outward supply of 20,000 in November. I file 20,000 in November. And I don't file my return till say August 2021. And on 25th of August, I file my return for the month of November, wherein I set off the liability of 20,000 from 1 lakh rupees. Now, since I have filed my return after the due date, the date of utilization would be the due date of filing of return for the month of November. That is 20th of December. But while filing the return for the month of December 2020, which is filed on the next date itself, that is on 26th of August, say, for the sake of simplicity, I reversed that credit because I came to know while filing the return for the month of December that this 20,000 was wrongly utilized. I would still be liable to pay interest for the entire period from 20th of December 2020 to 26th of August 2021. Because my date of utilization would be the due date of filing of return for the month of November, and my date of reversal would be the date of filing of return for the month of December, in which I have reversed that amount. So this was all about the calculation of interest under section 50 subsection 3 read with rule 88B. Now coming on to some other amendments. There is no reversal of ITC which is required to be made on duty credits if the rule has been suitably amended by inserting the explanation, inserting clause D to the explanation. Now the question comes that whether it is a prospective amendment or retrospective amendment. In my opinion, whenever an explanation is amended, it is always to clarify certain things, and this explanation should apply retrospectively from 1st of July 2017. So in case of any exporter, if duty credit scrip has been sold after 13th of October 2017, and since it was exempted after that date, no credit is required to be reversed. Now, another interesting amendment which has been made to Rule 89. And the amount to be taken for turnover of zero rated supplies or the value of goods exported. Now they have said that value of goods exported would be equivalent to the FOB value of export. Now the question comes that if the turnover of zero rated supply of goods is taken to be FOB value, then what would be my adjusted total turnover? Let's take an example that I am an exporter who only has a export turnover, and my export turnover is 5 crore rupees, and I have exported those goods on a CIF basis. Now my FOB value of the export is say 4 crore rupees. So as per the amendment made to Rule 89 and the definition of value of goods taken out of it, exported out of India, my turnover of zero rated supply of goods would be 4 crore rupees. Now the question comes, what would be my adjusted total turnover? Supposedly I have a credit of say 50 lakh rupees. So before this amendment of this FOB value, my export turnover would have been 5 crore rupees. My adjusted total turnover would have been 5 crore rupees, and my ITC was 50 lakh rupees. So therefore, I was entitled to refund of entire 50 lakh rupees. Now, since the value of goods exported out of India is 4 crore rupees because of FOB value, if I go through the literal interpretation, value of goods exported out of India is 4 crore. Adjusted total turnover is 5 crore rupees. My ITC is 50 lakh rupees. So I would only be eligible for refund of 40 lakh rupees. So is this the meaning which I need to take for this? In my opinion, if the numerator and denominator should always be the same. If my FOB value, if my turnover of export is being considered as 4 crore rupees, taking as my FOB value, my adjusted total turnover should also be 4 crore rupees. It can never be 5 crore rupees. And this principle has also been enunciated in circular number 147 dated 12th March 2021, although for a separate purpose. If we remember that amendment was made in the definition of turnover of zero rated supplies in Rule 89, which provided that the zero rated supplies in Rule 89 would either be the invoice value or 1.5 times of the value of like goods domestically supplied by the same or similarly placed suppliers, whichever is less. In that circular, they clearly provided that if the export turnover is substituted with a value of 1.5 times of like goods, then the adjusted total turnover should also be substituted with that value. The circular clearly provided, accordingly, it is clarified that for the purpose of Rule 89.4, the value of export oblique zero rated supply of goods to be included while calculating adjusted total turnover will be the same as being determined as per the amended definition of turnover of zero rated supply of goods in the said sub rule. The same explained by the following illustration where actual value per unit of goods is more than 1.5 times. So they also explained it with the help of an example. So this was the amendment in Rule 89. I'm only taking the important amendments which have been provided or important clarifications which have been provided, which somewhere down the line benefits us. Now comes the case of perquisites provided by the employer as per the contractual agreement. Now, circular number 172/2022 provides that any perquisites provided by the employer to its employees in terms of contractual agreement entered into between the employer and employee are in lieu of the services provided by the employee to the employer in relation to the employment, and therefore such provision of perquisites by employer to employee will not be subjected to GST. So supposedly I am an employer and I provide a rent-free accommodation to my employee, and it has been provided in the contractual agreement. This provision of service by employer to employee of the rent-free accommodation, since it is part of the contractual agreement, would not be treated as supply of service. But the thing does not stop here. But the circular stops here. It does not provide what happens if for providing such rent-free accommodation, the employer charges some amount from the employee. In my opinion, once it is established that the rent-free accommodation has been provided to the employee as per the contractual agreement, the entire transaction goes out of the purview of the supply. And once the transaction goes out of the purview of supply, whether or not I recover something from employee is immaterial. Just as in the case that when I sell a land to a person, since the sale of land is outside the purview of supply, whether or not I receive consideration on such sale of land, it is immaterial because the transaction itself is outside the purview of supply. So if the circular says that the provision of facility or service by employer to employee in terms of contractual agreement is outside the purview of supply, whether or not the employer receives something from employee, it is immaterial and it would be still out of the purview of supply even if some amount has been received. Now coming to the next clarification, that whether an amount lying in electronic credit ledger can be used for paying liability through DRC 03 or for appeal, that is 10% pre-deposit against payment of tax or reversal of ITC. This circular clearly provides that any payment towards output tax, whether self-assessed in return or payable as consequence of any proceeding, it can be paid through utilization of amount available in the electronic credit ledger. So when the term uses consequence of any proceeding instituted, it includes DRC 03 at the insistence of the department or DRC or 10% pre-deposit at the time of filing of the appeal. But since the definition of output tax does not include the tax payable under reverse charge mechanism, therefore electronic credit ledger cannot be used for making any payment of tax towards the RCM. And also, the RCM is to be paid in cash, so nowhere the credit ledger can be used for payment of RCM. Now coming to the last part, then I would be happy to take the questions. Levy of penalty in case of fake invoices. There are 3 examples given in the circular. I would not be going into the detailed part of the circular. The only thing which I would like to highlight is the levy of penalty under section 73 vis-a-vis section 122. This says that if A has made issued an invoice to B without underlying supply. So the circular says that since A has issued an invoice to B without an underlying supply, therefore, since there is no supply under section 7, therefore, no proceedings can be initiated under section 73-74 because 73-74 says tax not paid or short paid. So therefore, in such case, only penalty would be leviable under section 122(1)(2) for issuing invoice without actual supply of goods or services from by A to B. So in this case, wherein A has only issued an invoice without underlying supply, A would be leviable to penalty under section 122(1)(2). In my opinion, this is not the correct interpretation because section 76 is there. It says that the tax which has been shown in the invoice has to be deposited by the supplier. And invoice is the sole base document on which the entire statute is working. And if I have issued an invoice wherein the tax has been shown, a fake invoice supplier cannot be let free merely because he has not made an underlying supply. He has issued an invoice, he has showed a tax, so that amount of tax also needs to be recovered along with the penalty in the section 122(1)(2). Issuance of invoice cannot be taken lightly because there is no underlying supply. In my opinion, somewhere down the line, this circular incorrectly interprets and ignores section 76. Now coming to the second aspect, a registered person A has issued tax invoice to another registered person B without an underlying supply of goods or services, and B avails ITC on the basis of said invoice, and B further issues a sub invoice along with underlying supply of goods or services of both to his buyers. So now in this case, B has taken an invoice without a receipt of goods and used an ITC against further supply of further output tax liability. But that output tax liability is a genuine liability. So in this case, what they have said that B should be liable for demand and recovery under section 74 for wrongly availing availing or utilizing ITC. But the most important part in this circular for this part is when they say that as per provision of section 75(13), if penal action for fraudulent availment of utilization or ITC is taken against B under section 74 CGST Act, no penalty for same act, that is for said fraudulent availment or utilization of ITC, can be imposed on B under any other provision of CGST Act, including under section 122. So if a penalty has been imposed under section 74 on B for wrong availment or utilization of ITC, no penalty for same offense would be leviable under section 122. But the question is, what is meant by the term same offense? Whether mentioning of the offense in two different provisions mean two different offenses, whether mentioning of the provision in the same section means the same offense. In my opinion, the difference between two offenses or the definition of same offense is wherein an additional evidence is required to prove another offense, then they are two different offenses. When same set of evidence is sufficient to prove two offenses, then they are same offenses. So supposedly I have taken an invoice without underlying goods and I enter into my books of accounts. This is falsification of books of accounts. It is not wrong availment, because entering of invoice in the books of account does not mean availment of ITC. When I would be claiming it in my 3B, that would mean as availment of ITC. So falsification of books of accounts and availment of ITC are two different things, because an additional set of fact is required to be proved that whatever was entered in books of account has also been claimed in 3B. So whenever we decide about same offense, we have to be very clear what is the scope of the term same offense. But whenever after this circular, whenever you receive a notice which provides that you are liable for penalty under section 74, read with 122(2). I have always been of opinion that section 74 is a complete code in itself for the 5 offenses which it refers. It never requires the support of 122(2)(a) or B for levy of penalty. Any notice which is issued for levy of penalty for section 74, read with 122(2) is ultra vires. Section 122 is a separate provision and section 74 is a separate provision, and that is very well clarified by this circular. Now, third query, wherein A has issued an invoice to B without underlying supply. Now B also issues an invoice to C without an underlying supply. Now in this case, since we have not made a genuine supply, therefore the circular says since there was no underlying supply, therefore recovery under section 74 cannot be made. The only provision in case of B would be liability for penalty under section 121(2) for issuing invoice to C without underlying supply, and 121(7) for taking ITC without actual receipt of goods or services or both. fully or partially. So this is how we have to understand, and somewhere down the line in situation A, ignorance of section 76 is incorrect to my opinion, but in situation B, they very well clarify that 74 is a standalone section in itself. It does not require support of 122 to stand on it. So with this, I would like to conclude my today's session, and thank you to FIP for giving me this opportunity, and I would be happy to take queries of the participants if there are any.
Anyone have query, please share on the chat box.
There is one query from Venkatesh Babu. Right, kindly throw some light on RCM on residential rent for GST registered people, sir. Like if someone running some home business, what to do? Also, if we pay under RCM, is it eligible for ITC as it is personal use of house also is there? Kindly express your view. See, very clear that if I'm a registered person and I have taken a residential premises on rent and I am running a business from it, I am liable to pay RCM. And secondly, if I'm partially using it for my personal purpose and partially for my business purpose, then in such case, partial credit would only be allowed, because this property would be treated as the entire property would be treated as your property being used for in the course of furtherance of business. So you would be liable to pay RCM, but since part of it is being used for your personal purpose, therefore by virtue of section 17(5), wherein the inward supplies are used for personal purpose, that amount of ITC, proportionate ITC would be required to be reversed. So it's better to plan in a way that you use the premises exclusively for your business, or draft an agreement in a manner wherein part of the premises which is being used for business, there is a separate rent agreement, and part of the price which is being used for your personal residence is a separate rent agreement. See, section 38, clause 2 and 5 are different, because 5 says mismatch between 3B and 2A, claiming excess credit, and clause 2 says when where there is a default in payment of tax. And mind you, GSTR 3B is filed after GSTR 1. So my supplier would have filed his GSTR 1, it would be eligible for claim under credit under section 38, and they would be knowing that default has been made in payment of tax in the subsequent month. So in that subsequent month, that particular credit which was shown as allowed would be shown as disallowed in the subsequent month. See, 49 subsection 10 is very easy. I have a registration in Maharashtra and I have a registration in Rajasthan. There is an excess cash balance in Maharashtra and I want to pay liability in Rajasthan. So one way is to get a refund of the cash ledger and then transfer it to Rajasthan. Now the mechanism provided that the amount can be directly transferred from Maharashtra to Rajasthan. Whether rate of interest under section 50 sub 24, now no, it is 18% from 1st of July 2017. What could be the rationale for mentioning 30th number instead of simply telling due date of October GST return? See, again, due date of October GST return, then if the due date is extended, it would be extended. Supposedly, due date for filing of GS1 is extended from October for a particular state, then in that case, the due date for claiming or all the due date would be extended. So they have linked with a particular date, and that's why it has been treated deadline. Section 16 always says that we can avail ITC only supplier paid to government. How to contest notice from government seeking reversal of ITC? You can go through LGW by Honorable Calcutta High Court. You would get ample amount of case laws, ample amount of your submission, the material for a submission from that case law. No, it is not at all a good way to hold GST amount from the collected by the new registration person. 29 applicable for financial year 21-22. See, this is procedural amendment. So anyone any proceedings after 1st of October 2022 would only be applicable for this. Interest is still leviable if amount is deposited in cash ledger. It is not that if amount is deposited in cash ledger, interest would not be leviable. See, supplier ranking system is there in the statute. The only thing is it has not been made available on the portal. Kerala state has provided it, it has to be followed by other states or by the GST as a whole, but it has not, it is there, compliance rating is there in the statute in GST. The only thing is it is not there on the portal. 4910 is not enabled on GST portal. It is nothing new because the portal always was 6 months down the line. Can department issue notice for ITC mismatch of 3B and 2A from 1718? In my opinion, they cannot issue a notice. But this is again a lengthy and detailed discussion, so I will not be going on to that discussion. Department sending for 2A mismatch nowadays, that has also been already been covered. Anytime, these are all covered. What is your suggestions to GSTC to get seamless flow of eligible ITC, sir? I am a very small person to give suggestions to GSTC, but the only thing is that they are trying to hinder ITC to 99% because the 1% person who are not paying are illegally utilizing the government resources. So you cannot harm 99% because 1% persons are wrongly utilizing or wrongly implementing the provisions of the law for their convenience. It is entirely incorrect. It is somewhere the fault of the system if they are not able to identify. Non-implementation of RFID is also one of the prime reasons for that. What is the relevance of 30th number for availing ITC? Any return which you have filed up to 30th of November or due date of October shall be 20th of November. No, it is not as if that all the persons are filing their 3B on time. It might be possible that my July 2022 return is pending for 3B. So even if I am claiming the return for July, in the return for the month of July 2022, it has to be filed up to 30th of November. If I am claiming a credit for 21-22 in my return for July of next year, it has to be filed before 30th of November, so as to be enabled to claim the credit for 21-22. Best way to get updated with all amendments, we have to read and read and make it a habit. Once we make it a habit, we would be updated. No, there is no provision for transferring of ITC from one state to another. It is only for cash ledger. So these are all the queries, Harsh. Up till now, I have taken all the queries. So handing over the session back to you.
Thank you, Arpit sir. Thank you for enlightening us with recent amendments in GST. And thank you participants also for bearing with us for so long. And I hope all the queries are resolved as of now. अगर आपकी किसी की भी कोई क्वेरी है अर्पित जी से अगर आपको पूछनी है तो आप जो है FIP के टेलीग्राम या फिर टेलीग्राम ग्रुप में आप डाल सकते हैं. We will try to resolve it through sir. And PPT will be shared on Telegram group. So please सब connect कर लेना Telegram पे. You have to just search Federation of Indian Professional FIP India. So let's reconnect tomorrow at same time and same platform. Thanks all for thank you all and thank you sir. Thanks a lot. Signing as of now. Thank you. Thanks a lot.